Welcome everyone to Vested Interest. This is Shane and this is our weekly portfolio update. We do this every Sunday morning covering exactly what I bought in the portfolio the previous week. Also any options I was in, any dividends received. I covered that all out in the open. On this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the portfolio weekly. Like I said, we do a weekly update. That's what this video is, where we cover those investments and all the activity, anything I sold, dividends received, options, as I mentioned, that I was in. I cover that all out in the open weekly. There is nothing to buy, nothing to see. But if you would like to help out the channel and dividend investing or investing in general is your thing, if you could do me a big favor, it doesn't take but a couple seconds of your time, doesn't cost you anything financially, but it does really help out a small YouTube channel like mine. Hit all the buttons down below, that thumbs up button down below if you are a dividend growth investor or again, investor in general and find any value in the content. Make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever I put out any new content. Along with this weekly series where we cover my portfolio update, I do a stock pick of the day series Monday through Thursday. When the market is open, we take a look at a company stock that's pulled back on the day, run it through my screener, see if it makes it onto my watch list. So if you're interested in that type of content, again, hit all those buttons. There is the thanks button for anyone who might want to buy me a cup of tea and support the channel financially that way. And a special thank you to all the viewers and subscribers of the channel. The channel continues to grow because of people like you. All right, into the portfolio activity options. Nothing to report on options. We threw out 3 or 4 more plays this week. No one bid on the other side, and that is the thing about options. You've got the writer, that would be me, of the contracts, and then you have to have someone on the other side to buy those contracts or sell those contracts. In my case, I sell covered calls or cash secured puts, so I'm looking for a buyer on the other end, and then I collect that options premium and reinvest it back into the portfolio with the intent of keeping the shares while I collect that options premium. Sometimes if the shares are called away, then we'd go on the other side and do a cash secured put with those funds and run what is called the wheel. There is the wheel strategy. I've done a video on that in the past. Let me know if you're interested in that. I can flip you a link to that video so you can see what that's all about. All right, into the first actual activity, dividends. We did receive some dividends on the 13th. Pfizer paid us $247.01, and we do have the DRIP set, so that stands for Dividend Reinvestment Plan, and that just means anytime a position in the portfolio pays out dividends, the funds go automatically right back in, reinvested back into the same company. I don't have to do anything. The portfolio does it automatically for me. If I take the DRIP off, then I collect the dividends and I have to do something with that cash. But for now, all of my positions in the portfolio, the DRIP is set. And unfortunately, in my portfolio, I cannot selectively choose which companies I want the DRIP set on. It's either all or nothing. I do hope that my brokerage changes that. There are some companies that have run up significantly, like AT&T in my portfolio. I would probably turn off the DRIP and take those funds and put elsewhere. But for now, I'm leaving the DRIP on all positions. But let's get back to Pfizer. Ticker PFE, out of the healthcare sector, paid us $247.01. With those funds that are reinvested, that picked up 9.9843 more shares of Pfizer. That 9.9843 additional shares added $17.17 in additional passive income over the next calendar year. We also received dividends on the 16th, not the 13th. That was Pfizer's payout. The 16th, we received dividends from a couple different companies. First up, Alphabet, ticker GOOGL. This is out of the information technology sector. Paid us $29.01. Again, the DRIP is set, so those funds went right back up into Google and picked up 0.16569 more shares of Alphabet there. NextEra Energy was the other one that paid us, ticker NEE, and Google's ticker GOOGL, if I didn't mention that. NEE there for NextEra Energy paid us $114.54. Those funds went right back up into NextEra Energy and picked up 1.53088 more shares of NextEra Energy. Google shares and NextEra Energy shares picked up, added $3.59 over the next calendar year. Total of $143.55 paid out by the two companies there on the 16th. Now we get into the first new capital. There also on the 16th, we added $195.79 in passive income. With those funds, we added just one share to three different positions. One share of Vale, ticker VALE. This is a mining company out of the materials sector. Picked up that one share at $9.82. Picked up one share of Pfizer. So not only did we get dividends, we also picked up a share there of Pfizer, ticker PFE, out of the healthcare sector. Picked up that one share at $24.49. And one share of Procter & Gamble, ticker PG. Haven't added to this one in a while, but I like it around this 161 or below, 160-ish or below is where I like Procter & Gamble. I think actually by the end of the week it was down to a little under in the 158, 159 range. We'll see that here towards the end. So I may be looking to add to this one again next week as well as it pulls back towards my cost basis here. Picked up that one share of Procter & Gamble, ticker PG, out of the consumer staple sector at $161.48. This $195.79 added, and the new positions picked up with those funds added $6.68 in passive income over the next calendar year. Now, we weren't done. We went back into the portfolio on the 20th here and added an additional $375.55. With those funds, we added to our weekly buys. We add SCHD and VTI, these two ETFs, every single week, regardless of the market conditions. Usually on Thursday or Friday, we go in and add these two to these two positions, and maybe one or two others if we have extra funds. Right now, I have backed off a little bit how much I'm putting into the portfolio. So right now, again, you're only seeing me add sparingly to some positions, but these two we will add to regardless of the market, at least through the end of the year, and then we may adjust adding to VTI just whenever it pulls back. I'd like to get to 100 shares of VTI. And then maybe we adjust from there. But for right now, these are the two we're adding to every week. So we picked up 3 more shares of Schwab Strategic Dividend Growth ETF, ticker SCHD. Those 3 shares we picked up at $26.71. And 1 share added to our Vanguard's Total Stock Market ETF, ticker VTI. 1 share picked up at $295.42. Now, the $375.55 and the new shares added to these two positions added an additional $6.92 in passive income over the next calendar year. Total invested $571.34. Total passive income added, not only with the new capital that I added, but also the dividends and the shares that they picked up, $34.36 added in passive income over the next calendar year. All right, let's run through the portfolio sector weights here. Right now, the breakdown looks like communications at 10.24% of the portfolio. Still nothing in consumer discretionary outside of what we hold in SCHD and VTI in those sectors. Consumer staples, 8.73% of the portfolio. Energy makes up 10.23% of the pie. Financials at 2.44%. Healthcare makes up the second largest piece of the pie at 18.55%. Industrials at 6.43%. Technology makes up the largest portion of the pie at 19.91%. Materials at 2.21%, utilities at 3.92%, REITs and real estate at 5.98%, and ETFs is creeping up there. Eventually, again, this will be one of the larger positions, or the largest at the end of the day, because of the nature of adding to SCHD and VTI every single week. Over here to the right, you can see those same sectors along with the percentages that matches up to the pie and the dollar amounts allocated out of the overall portfolio as well. Well, this is it. I show it every week. I think it's important to show it every week, and I think I say this every week. I want to be as transparent as possible, showing you what I am doing, showing you a real portfolio built out over time so you can see the ups and downs associated with not only holding ETFs, but also holding individual positions. Every company, stock, and every ETF out there or index fund has a 52-week high and a 52-week low, and just because a company has pulled back does not necessarily, or ETF has pulled back, that does not necessarily mean it is time to buy, and it doesn't necessarily mean it is time to sell, right? A lot of people see red and they want to sell because they are worried something has changed or their position is losing money. You only lock in a gain or a loss whenever you sell. So again, you see I have 1, 2, 3, 4, 5, 6 different positions out of my portfolio that are in the red. I am not running out and selling these positions just because they are in the red. Comcast, for example, if I thought was a good buy at $39.30, it should be a better buy at $34.53, bringing down my cost basis as I add to it increasing my dividend yield, increasing my potential future returns. Now, if something had fundamentally changed with Comcast or any position, this is not just specific to Comcast, but any position I hold, if something fundamentally has changed, revenue is decreasing, sales are declining, their margins are collapsing, they are in trouble with their debt, right? They hold less cash, they can't pay their debt, or they can't, maybe their dividend yield is over 100%, their payout ratio is over 100%, I mean. Then maybe there's something wrong with the company. They don't have enough free cash flow to cover their debts and their dividend. Then we would want to look and do a deeper dive into the company's financials, their balance sheet, their income statement, their stuff like debt to equity ratio in there. How much cash do they hold on hand? What is their debt looking like? Is their debt coming down? Are they buying back shares? Is their revenue growing? Are their margins expanding? A lot of different points to look at in the balance sheet, the income statement, under the hood of a company to say whether or not the company is doing well. If you do not understand how to read a balance sheet and income statement, maybe individual stocks in the beginning are not the best choice for you. Maybe you should look at an ETF or an index fund. Warren Buffett, who's a much smarter investor than I am, would recommend the S&P 500. Now, I picked VTI, which is not the S&P 500. It is the total United States stock market, right? The S&P 500 is just the top 500 companies. That's what Warren Buffett would recommend for the average investor. He is a big believer in American growth over time, so he recommends the total stock market. I picked VTI and yes, SCHD, that's another ETF, because I like the total stock market, which includes emerging markets and small caps. The top 500, which is the S&P 500, just includes those top large cap companies in the stock market. So I pick VTI because it covers more, gives me a little bit more diversity. Some people even pick a company like VT or an ETF like VT, which covers the entire world, which, okay, if you want even more diversity, go ahead. But in my opinion, there are quite a few companies in there that are a drag on VT. And again, I really believe in growth of America over time. So that's why I pick VTI. And SCHD, which is the dividend growth ETF, which I like because it matches my investing style. There are a lot of different index funds and ETFs out there that you can choose from. VOO would be the S&P 500. I know that Schwab has their own, and VOO would be Vanguard. Schwab has their own. BlackRock has one. All the different fund managers out there have their own S&P 500 ETFs or index funds. Their total stock market like VTI index funds. VYM is like SCHD, so that would be Vanguard's comparable to the dividend growth ETF that I like, SCHD. So there are different funds and different ETFs, index funds out there that would probably match your investing criteria. Figure out what your investing criteria is, how you want to invest long term, and then do so accordingly. Like I said, if you don't know how to read balance sheet and income statements, stick to ETFs and index funds originally, and then you can learn as you invest how to value a stock, how to read balance sheet, how to read income statements, so that you don't run away whenever you see a pullback like 12%, or down here, Vale, 19%, right? 11% with Pfizer. You just saw me add another share to Pfizer. Comcast I've been adding to. Didn't add any this week, but I have been adding to that one. HPQ I recently added to. It's down. So I see these red areas, if there's nothing wrong with the fundamentals of the company, as opportunities to buy. Now, that does not mean that I do not add to positions that are running up. Procter & Gamble, you saw me add to this week, 159.08. That's where it got. So I bought this one at 161 early and some change earlier in the week. My cost basis is $154.94. So I'm still up on this position, but it's close enough to my cost basis I'm willing to add here, right? Owens Corning, I recently added to this one. I'm still up 11.7%, right? I like it under $140. So this one might be one I add to next week as well. So just because a position is down does not necessarily mean it's a reason to sell. Just because a position is up on the flip side does not mean it's a reason not to add to that position. If it is undervalued, again, that comes down to being able to value a company. What do you place the value of the company on? And that should be based on its free cash flow, forecasted out over the next 4, 5, 6, 7, 8 years, whatever time frame you look at, 10 years if that's what you're looking at, and then discounting that cash flow back to today's dollars and saying this is what I'm willing to buy it. It would be no different than if you went out and wanted to buy a company. And that's what you are buying. You are buying companies. You are not just buying digits on a screen. You are buying a percentage or a piece of the company That is what the underlying stock represents. It represents a piece of that company, and it represents a piece of all that company's future free cash flow that you want as an investor, right? So if you don't know how to value a company, stay away from individual stocks, stick to ETFs or index funds. And again, Warren Buffett would recommend something like VOO or another fund or index fund or ETF that tracks the S&P 500. All right, I think I've covered that enough. Let's finish up this video. Here are all the different positions in my portfolio in this column. Total shares on all of these numbers will be as of the close of business on Friday. And it's actually, whenever I go in and do my updates, typically it's Friday or Saturday morning. So it's really after the after hours numbers on Friday afternoon, right? So current price in this column, market value in this column, average cost per share. That is my cost per share, but it does include reinvested dividends. So it's not just the amount that I bought on the first tranche, which some people track and then they compare it to where they're at now. This includes as I continue to invest and as dividends get reinvested, this gets adjusted. Purchase price, same thing. Total return here, whether I'm up or down, you're going to see it. And again, it does include reinvested dividends. Percent return here. Again, red means I'm in the negative, green means I'm in the positive, the darker green means the higher it is. The two best performing positions right now are Kroger at 58.94% in the positive and AT&T up 61.17%. But then we've got some others like Ally up 41.7, CSCO, Cisco here is up 37.99%. Several in the 20% range. Lam Research, LRCX here is up 24%. I mean, we were buying this recently down here below 72.92, right? Now it's up again. NextEra Energy is up 24.57. This is another one. If this drops back below $70, it's currently at 71.53. I was adding to this not too long ago, right under $72, right in the same range, 71.53. I probably will wait if it drops below 70 again, since it's a larger position here, a little over $11,697 into it. I really would like this under $70, right? But it's real close to my buy price right now. So I may look to add to that one. But for right now, I'm probably really focused on the ones in the red here. But I do like Owens Corning right now. And I like Procter & Gamble right now. I'd love to get these both to 100 shares while they're around my cost basis. 130 I think is a great buy for Owens Corning. Around 160 or under, I think is a great buy for Procter & Gamble. Again, NextEra Energy, I'm just throwing out some additional information here. Sorry if I'm getting off into the weeds. NextEra Energy, I think is a great buy around 72 or lower. There's other ones that are very close to the buy range. SCHD, I just, again, add to it every week, right? That's what I do. Cisco here, SYY, I like this one around 70 or below as well. All right, but let's continue here. Percent return we covered. Sector, which each company falls, and what we saw on the previous slide was each overall sector weights. This shows you which each individual position sector they fall in, whether they're a quarterly, monthly, semi-annual payers. I actually don't have any monthly payers right now. I used to have Realty Income in the portfolio, but nothing currently that pays me monthly. Semi-annual here, current dividend yield here, my yield on cost, portfolio weighting here, estimated annual income in this column, payout months, typically whenever they pay out. Now, positions will slide into a month before or after their typical payout, depending on, if they pay out at the beginning of the year and it was to fall on a weekend, maybe they pay out on the month before. If they fall close to the end of the year, and again, it's close to a weekend or a holiday or something, maybe they pay out the month after. But typically, these are the months they pay out. Dividend growth year over year, we do adjust this. That's what these ones in highlighted yellow mean. They are positions that have already raised their dividend for the year. And I adjust. As they raise their dividend, I adjust the payout, right, as well as the dividend growth. 15% of a 52-week low. This adjusts. I usually adjust this every other week, so it might not be completely up to date for every different position, but I like to use this as a high water mark. Let's look at Owens Corning and Procter & Gamble for examples. Owens Corning, I mentioned that I'm up 11.7%, right? But I still would like to add to this position. I'm not quite to 100 shares. I'd like to get it to 100 shares. I do that. The 100 shares mark for me is because then I can run covered calls on the position. That's why I do that. It's partly tied to some options that I can do to help try to even though I haven't been doing great in options, it gives me opportunities and options to run options on. It gives me options to run options on. That's weird, but that's what it does. So Owens Corning, we're at 79.7894 shares. I'd like to get this to 100 shares, but it's currently above my cost basis. Well, let's jump over here to 15% of a 52-week low, which is what we were talking about. I can buy this as long as my cost basis, my average cost per share, which is 118.04, is below 141.92. Or the other way to look at it, I like to buy whenever the current price, which is 131.85, is below 15% of a 52-week low. So it meets both. I could add to this, even though the current price is above my average cost per share, I could add to this as long as it stays under 141.92 or as long as my average cost per share stays under 141.92. So that's a good way to look at it. Procter & Gamble, same thing. I'd like to get this to 100 shares. My cost basis is 154.94, which is very close to where it's at $159.08. But 15% of a 52-week low is $180.06. Is that right? I'm gonna have to check that and see if that's right. It seems high, but that's what it says right now. Let me adjust that and make sure that's correct at the end. Hold on, we'll do it right here while we're on. I've got my phone with me, so let's do the math on that one just to make sure that is correct. And we'll just say 159. Well, I'll check that in a little bit. I don't want to spend too much time there, but $180.06. So I can add to this position, Procter & Gamble, as long as my average cost per share is under $180.06, or as long as the current price is under $180.06. That's how I use this 15% of a 52-week low. It is the high water mark where I want my average cost per share to go. Now it does adjust over time because obviously as companies go up in price, their 15% of their 52-week low will go up in price as well. All right, as we wrap this one up, total shares 7,480.037 shares, market value of $371,423.73. I do have $342,008.61. This again does include reinvested dividends, so it's not just new capital that I'm investing, but it also includes that options premium that I put in the market whenever I get it, and as well as reinvested dividends. Total return up $29,415.12 or 8.6%. I say this every week as well. I do not focus on this. It's nice to see that I'm up. It's nice to see that I'm in the positive. But unless I sell all the positions in the portfolio, I do not lock in this gain, right? And if I was down, it wouldn't matter unless I sold all the positions in the portfolio to lock in that loss. So you only lock in a loss, or a gain whenever you sell the position. That's when you lock in losses or gains. Now you want to try to build in, those gains in the beginning, estimating, okay, I'm 20% undervalued, so I'm going to buy right now, right? But only when you sell do you actually lock in the loss or the gain. So I'm not looking to sell these positions. I'm looking to collect the dividends over time. So that's why I do not really focus on, again, this return. Current yield 3.569%, yield on cost currently 3.876%, and this estimated annual income, this is what I'm focused on. That's why it's circled over here in red. The annual income from the dividends paid out from all the different positions and ETFs in the portfolio, and this grows weekly, monthly, quarterly, yearly as I add new capital, as the positions in the portfolio pay out dividends, and as those dividends get reinvested, and as I, get some options premium and reinvest that as well, and currently sits at $13,255.65. We are going to, it looks like, be over $14,000 in estimated annual income by the end of the year. I don't know that we'll get to $15,000, but it definitely looks like we are going to here probably in the next 2 or 3 months get to $14,000. Dividend growth year over year, 5.89% currently. And that is really the portfolio update for the week. How is your portfolio doing? Mine was doing very well up until the last few trading days here, where it seems like we hit a turnaround, and I think a lot of that is due to the Iran conflict that we are potentially getting drug into by Israel. I hope they do not end up using our military, especially boots on the ground, to support this war. In my opinion, it is not our war. We need to stay out of it. So not to get political, but I was in the military, and I am never an advocate for sending someone else's sons and daughters off to war. I've seen what it looks like. It is not what you think it is. It is not what you see on TV that may glorify war. There are really no winners. There are only losers. And typically, whenever you have wars like that, all you do is create more animosity and future warriors. That's it, on both sides. Because if someone watches bombs being dropped on their mom, dad, cousins, aunts, uncles, family members in general, they are going to blame whatever company or country dropped those bombs. They don't care the reason that those bombs were dropped. They don't, you know, care that we were doing it because we're Christians and we're supporting Christian fundamentals or whatever. Because in my experience, both sides of the war, American side, the other side, Israel's side, Iran's side, Russia's side, excuse me, Ukraine's side, neither one of them are looking at their side saying, we're fighting for evil, we're fighting for the bad side. Both of them think they are in the right. Both of them think they are justified. Both of them think they are the good guys. That's how war looks. You have two sides fighting, thinking that they are equally justified and equally in the right. So I hope that we stay out of the war, but I believe what I'll get back to is that is the reason we are seeing another pullback right now, as well as tariffs are still involved. Whether we're on a hold or not, it looks like we're going to end up with higher tariffs than we started the year. So that will impact stocks as well. All right. That is really it for this one. Let me know what's going on in your portfolio. Did you see a pullback this week? What did you add, if anything? Are you running options? How's that going? And what dividends did you receive? Would love to hear from you in the comment section down below. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. Let me know what's going on in your portfolio. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor. For those of you who made it to the end, I really do appreciate you watching. Watch time is one of the other metrics that the YouTube algorithm looks at. Don't forget to subscribe on your way out. Hit the like button. Share with anyone you think that might find value in the content. Drop a comment. Let me know what you think. And we'll see you in the next one.